Welcome to the deep dive. Today we're digging into Nike Inc.'s latest Form 10Q. That's their first quarter for fiscal 2026 ending August 31st. We're going to try and pull out the real story from all those numbers.
Yeah, this filing is pretty important. Really lays out, the challenges they're facing right now, but also the strategy they're putting in place.
And it presents a bit of a puzzle right off the bat, doesn't it?
It really does. You look at the top line, total revenues, and they're actually up slightly, about 1% year over year, hitting $11.7 billion.
Okay, so stable revenue seems fine, but then you look at the profit.
And that's where things get, well, dramatic. Net income just plummeted, down 31%.
31%. Wow. And that translates to earnings per share too, right?
Absolutely. Diluted earnings per share, a key metric everyone watches, fell hard. From 70 cents last year down to just $1.49 this quarter.
So the big question for you, the listener, is why? How can sales go up, even a little, while profits fall off a cliff like that?
Let's unpack that. The core issue, really the main drag, was the gross margin.
Right, the amount they keep from each sale before operating costs kick in.
Exactly. And that margin shrank significantly. It contracted by 320 basis points.
Okay, hold on. 320 basis points, that's 3.2 percentage points, correct, just so everyone's clear.
Precisely. A 3.2 percentage point drop. For a company Nike's size, that's a huge hit to profitability per item sold.
So what caused such a big drop?
Well, management pointed to two main culprits. First, lower average selling prices, or ASP. That accounted for about 250 basis points of the drop.
Lower prices. So more discounts. Was that intentional?
Oh, very much so, it seems. They were running higher discounts, more markdowns. Plus, there were changes in their channel mix, basically how and where they were selling stuff. They pushed more through wholesale.
Which often means lower prices or higher return allowances, right?
Exactly. It was about clearing out inventory aggressively.
Okay, so that's the pricing pressure. What was the other factor?
High product costs, that was another 100 basis points shaved off the margin. And this one is largely external.
External how?
Mostly due to new tariffs hitting them in North America.
Ah, tariffs. That's a big one. Did they quantify the risk?
They did. The filing actually mentions they expect a gross incremental cost of roughly $1.5 billion annualized, just from these new tariffs.
$1.5 billion just from tariffs.
Yep. And they expect it to negatively impact their gross margin for the whole of fiscal 2026. So this isn't just a one-quarter problem. It's a sustained pressure.
Okay, so you've got unavoidable higher costs from tariffs hitting them, and they're choosing to slash prices to move old product. That sounds painful.
It's definitely a calculated risk. They're absorbing pain now. The filing talks about reducing supply of some older footwear lines to make space for new, innovative products.
And the way they make space is by liquidating the old stuff.
Right. More markdowns, especially through their own Nike Direct channels, and offering better terms like higher discounts and return allowances to their wholesale partners to take the inventory.
This sounds like a major shift, especially that bit about wholesale. Weren't they all about direct-to-consumer, like, just yesterday?
They were. Digital first was the mantra. But this filing signaled a clear pivot, or at least a major adjustment. They're now talking about repositioning Nike brand digital as a full-price platform.
Full price. So fewer sales online.
That seems to be the idea. Pull back on the heavy online discounting and simultaneously reinvest in their wholesale relationships. They seem to recognize they need those partners to handle the sheer volume.
Okay, that makes sense. If that's the strategy, clear inventory, lean more on wholesale, make digital full price, we should see it in the channel sales numbers. How did that break down?
The shift is really clear there. Wholesale revenues actually jumped, up 7% reported or 5% currency neutral, hitting $6.8 billion.
And was that volume or price?
Mostly higher units sold, according to the filing. But importantly, it was partially offset by those increased discounts we talked about. Confirms the inventory clearance story.
Okay, so wholesale up.
Yep.
What about Nike Direct, the channel they're trying to reposition?
That took the hit, as you'd expect with the new strategy. Nike Direct revenues were down 4% reported, 5% currency neutral, landing at $4.5 billion.
And where did that decline come from mostly, stores or digital?
Almost entirely digital. Nike brand digital sales dropped a significant 12%. That's down from $2.3 billion to $2.0 billion.
12%. That's a big deliberate cut in online sales volume.
It really shows they're serious about making digital less about promotions and more about full-price brand presentation. Their own stores didn't fare great either, though. Sales down 1% and comparable store sales were flat. Zero change.
So less foot traffic or conversion in their own stores, too. Now, how did this discounting affect different product types? Footwear versus apparel.
Yeah, that's interesting too. Let's look currency neutral. Footwear revenues actually decreased by 2%.
Decreased, even with all the discounting.
Well, here's the twist. Unit sales for footwear were actually up 2%.
Wait, so they sold more shoes,
Yeah.
but made less money overall from them.
Exactly. That 4 percentage point difference, that was purely the lower average selling price kicking in because of the markdowns. They moved more sneakers, but the clearance pricing wiped out any revenue gain and then some.
That really highlights the cost of this inventory cleanup. What about apparel?
Apparel was kind of the bright spot. Revenues there increased 7% currency neutral.
Okay, so apparel did well. Was that volume too?
Yes, and strong volume. Unit sales for apparel jumped 10%. So even though ASP was lower here too, down about 3 percentage points, the sheer increase in units sold was enough to overcome the discounts and drive solid revenue growth.
Interesting. So strong demand for apparel, but footwear needed heavy pushing. Okay, we've got the strategy, the channel shifts, the product mix. Now, how did this play out geographically? This is where it gets really interesting, right?
Absolutely, because the impacts weren't uniform. And looking at EBIT earnings before interest and taxes really shows the operational stress region by region.
Let's start with North America, their home turf and biggest market.
North America saw revenue growth, up 4% currency neutral. And that was strongly driven by wholesale, which was up 11%.
Okay, revenue up, but what about profit, EBIT?
EBIT actually decreased 7%, despite selling more overall.
Why the drop? Margin compression again.
Exactly. They took the biggest gross margin hit of the main regions, a 330 basis point contraction.
3.3 percentage points. Ouch.
Yeah, heavily impacted by those new tariffs we mentioned, plus all the discounting. So the growth they got, it was expensive growth.
Right. Okay, let's jump over to EMEA, Europe, Middle East, and Africa.
EMEA revenue was basically flat, up just 1% currency neutral. Again, wholesale provided the growth, up 4%. But it had to fight against a pretty big drop in Nike Direct, which fell 6%.
And with indirect, was digital the weak spot again?
Yep. Digital sales in EMEA dropped 13%. Same story. Pulling back on online promos hit volume. And just like North America, the profits suffered. EBIT down 7%.
Okay, consistent story so far. What about Greater China? That's usually a huge growth engine for them.
Well, this quarter, it was the opposite. Greater China saw the biggest regional decline. Revenues down 10% currency neutral.
10% down. Wow. Was that across both channels?
It was. Wholesale fell 9% and Nike Direct fell 12%. But the really stark number from China was digital sales.
Let me guess. Down significantly.
Plummeted, down 27%.
27%. That's huge. What does that signal? Just the digital pullback or broader issues in China?
It's likely a combination. It suggests that recalibrating digital is especially painful there, perhaps combined with maybe some softer consumer demand. And it hit the bottom line hard. EBIT in Greater China fell a massive 25%.
25% EBIT drop. Clearly the toughest region operationally right now.
By far.
Okay, one more main region, APLA, Asia Pacific, and Latin America.
The APLA was relatively stable on the top line, revenue up 1% currency neutral. Wholesale carried the load again, up 6%. But same pattern. Nike Direct revenues decreased 6%.
Digital down there too.
Digital down 8%. And their comparable store sales actually dropped 8% as well. So weakness in both direct channels. And the profitability. EBIT decreased 13%. Margin pressure is truly a global issue for them.
And we can't forget Converse. How did that brand do amidst all this?
Oof. Converse had a really rough quarter, just severe contraction across the board. Revenues cratered, down 28% currency neutral.
28%. Was that everywhere?
Everywhere. Declines in all territories.
Yeah.
And the profitability, EBIT, just collapsed, down 68%. The gross margin there contracted 620 basis points. That's a 6.2 percentage point drop, reflecting just intense markdowns.
Wow. So after all that discounting, especially in footwear and Converse, surely they must have made a dent in the inventory problem. Let's look at the balance sheet.
You'd think so, right? But here's the surprising part. As of August 31st, inventories were actually up 8% compared to the end of the previous quarter in May, reaching $8.1 billion.
Wait, up? How can they be liquidating so hard and taking margin hits and still have more inventory?
Management's explanation is basically product mix and an increase in units.
Yeah.
So yes, they're clearing out the old stuff, but they're also bringing in significant amounts of the new products they want to focus on going forward.
Ah, okay. So clearing the decks while simultaneously restocking with the next wave, that makes some sense, but it's still a lot of cash tied up.
It is, but they do have the financial strength to manage it. Their cash position is strong. Cash, equivalents, short-term investments. It all totals $8.6 billion.
So they have the cushion to navigate this transition?
Definitely. They had the liquidity. However, there was one interesting flag related to how they use that cash specifically, share repurchases.
Oh, what happened there? I thought they had a big buyback program.
They do, and they did buy back $123 million in stock during the quarter, but the filing explicitly says they moderated and ultimately stopped repurchases during the quarter.
Stopped the buybacks. Why?
They cited lower operating cash flows. Essentially, the hit to profitability from the margin compression and the costs of clearing inventory meant less cash was coming in the door. So they paused the buybacks to preserve capital.
That's a pretty significant signal, isn't it? Even with billions left authorized on the program.
It is. It shows the immediate cash flow pressure is real, and they're prioritizing operational stability and that cash cushion over returning capital to shareholders right now. They still have nearly $5.9 billion authorized under the current plan, but they hit pause.
Got it. Okay, finally, any other big risks or complexities mentioned in the filing we should touch on? Regulatory stuff.
Yeah, a couple of ongoing things worth noting. First, there's that European Commission investigation that started back in 2019. It's about whether some tax rulings they got in the Netherlands might count as illegal state aid.
Right, that could mean back taxes if it goes against them.
Potentially significant ones, yes. Second, there's a Belgian customs claim about potentially underpaid duties on products imported since fiscal 2018. They state they can't estimate the loss range yet, but flag it as a risk.
Okay. Tax and customs uncertainties. Anything else?
Just a brief mention of that new U.S. law, the One Big Beautiful Bill Act of 2025. They noted they're still evaluating it, but at this point, don't expect a material impact.
Okay, so wrapping this all up, what's the big takeaway from this Q1 filing?
So what does this all mean? I think this filing really confirms they're in the middle of a very calculated but definitely difficult pivot. They are deliberately taking these big hits to gross margin to profit right now.
Through the discounting, absorbing tariffs, pulling back digital.
Exactly. All in service of a longer-term goal. Getting the brand heat back, focusing on new innovative products that they can sell at full price down the line. It's short-term pain for what they hope is long-term gain.
And for you, the listener, this really shows how a giant global company like Nike tries to manage a major reset. They have levers they can pull: pricing, inventory, channel focus, even if it hurts financially in the moment. It's not panic, it's a strategic maneuver.
Right. And that mention of the new U.S. tax law, the One Big Beautiful Bill Act of 2025, even though Nike says no material impact yet, it brings up a fascinating final thought for you.
Oh.
Well, think about it. We see tariffs hitting them hard. We see new complex domestic tax laws being enacted. In this world of constant trade shifts and tax volatility, how do these huge multinational companies keep adapting? It's not just about reacting to tariffs. It's about planning R&D, capital investments. How do they try to anticipate or even benefit from these big, complicated new laws, both at home and abroad?
That's a great point. It's not just about this quarter's results. It's about navigating this constantly changing global landscape of taxes and trade rules. That long-term navigation skill, maybe more than just the immediate margin recovery, could be what really defines success for companies like Nike in the next few years.
Yeah.
Exactly. The long game in a volatile world.
An essential piece of global context indeed. Thanks for joining us for this deep dive.